Inflation is too high in Australia. As of late July, there is a 1 in 4 chance the RBA increase interest rates again at its next meeting. In this video, I'm going to go through specifically what the RBA are going to look at when they're deciding. I'm going to go through the inflation data and what that means for the Australian economy. I'm going to go through the tax cuts and the size of the fiscal stimulus the government has thrown at the economy in July and how it's a very different economy we live in right now than it was last month with the size of these tax cuts. Finally, I'm going to go through the unemployment data and what it means for the job story ahead. If you're interested in my thoughts and what other economists are saying about the RBA, definitely keep watching. Hi, I'm Ridham Syed, founder of Confidence Finance, a 6-times top 100 mortgage broker here in Australia, and I help property investors all across the country build, grow and scale their property portfolios. So, the RBA make their decisions using data available to them, but also consider what the Australian economy will look like in about 6 months' time. That's because every decision they make has a bit of a lag. It takes time for an increase in interest rates to feed through to the economy and actually hit the back pocket of Australians and change their behaviour. And as a result, the RBA are not only thinking about the data that's in front of them, they're also trying to make an assessment of where the Australian economy is at today and what it will look like in a few months' time. This is really tricky because of those tax cuts that have kicked in and the nature of how things are changing around everywhere, all around the world and in Australia. So the first and most important piece of data that's going to help the RBA decide is inflation. The inflation picture isn't pretty in Australia. To begin 2024, we had a 1% quarter-on-quarter print to begin the year. We're about to print another one somewhere in that vicinity. That suggests inflation is running at around 4% currently, significantly higher than the RBA's 2 to 3 percentage point band. That is the number one reason why the RBA will increase interest rates. Inflation, that is, the prices of goods and services in the Australian economy are rising too quickly. The RBA only have one thing they can do, and that is increase interest rates to further slow the economy down and stop people spending money and bring down price pressures in the Australian economy. So let's go look at inflation at the moment here and the RBA forecast. You can see that the RBA are projecting that inflation just kind of sticks around this current level for the rest of the year. Meanwhile, CBA, one of the country's biggest bank, their economists are predicting a big fall in inflation that starts from this quarter that we've just began, quarter 3 2024. It's really the energy price rebates feeding into the inflation data and bringing that headline inflation number down. That's what the RBA are predicting here, and that's what the major bank economists are predicting. So if this occurs, perhaps the RBA feel more comfortable with pausing interest rates and letting it slide for a little bit longer to just see how it plays out. Because if what CBA are forecasting actually happens, the RBA will be pretty happy with the inflation story. In this second chart here, I can see that the number of goods and services where inflation is running above the RBA band is starting to trickle back up. We're about half the goods and services running higher than the 3% inflation band, but that's starting to trickle back up, which suggests the spread of inflation could be a little bit concerning. It was on a downward path all the way from nearly 80% a couple years ago when inflation was simply way too high, down to about 50% today. But we want to see this number keep coming down. We want to see more than half of the goods and services in the basket coming in below the RBA's inflation band. That would really signal to the RBA that price pressures are going away in the economy. But if this continues to rise again, this little gentle uplift, then that would cause room for concern. You can also see the number of goods and services that have inflation below 2% is on the rise. So that means there's a bit of a spread happening in the rise and fall of prices. Some items are rising really quickly. Finally, I've got a really cool chart from Westpac that showcases what they expect to be in the inflation data this quarter that comes out very soon. This is the contribution of what is driving these high inflation figures. If you take a look at it very clearly, it's housing and health that make up huge contributors to inflation data itself. It makes up about 40 to 50% of the total inflation figure itself. So housing is rents and new building costs driving up the CPI higher, and then there's health costs as well. The RBA have got to really think about this. does increasing interest rates actually bring down rents? We're not seeing that. In fact, we're seeing the opposite. Increasing interest rates drives builders to not build homes, and that puts less supply into the market, and that causes rents to go up. So does increasing interest rates really help housing inflation? What about health? This is an item that people need to spend on. They don't care about interest rates when they're spending money on health. They're going to buy that stuff anyway. So will changing interest rates actually impact health levels of inflation? These are the questions that will be circling through the RBA's mind when deciding, does an increase in interest rates actually help slow the Australian economy down, or does it cause more damage? So that's the inflation piece. But the elephant in the room here is actually the growth data and the tax cuts that the government has thrown at the Australian economy. Now, people needed this. People needed a little bit of a kick up with their wages, and people needed that little extra income boost to get through this cost of living crisis. But the timing of this could barely be worse. We have inflation running too high, and we've just poured a lot of fuel to the fire by putting in $20 billion into the Australian economy starting this month. Inside everyone's pay packet this month, coming into their bank accounts, is a higher net pay, which means that they're going to start spending more, and that could force the RBA to increase interest rates to effectively unwind the government's own stimulus. That'll be a bit stupid. The government goes and gives everyone a little bit of money, and the RBA goes and takes it away via higher interest rates. It would be a crazy, stupid policy idea here where taxpayer dollars are being thrown at the economy only to be taken away by the central bank. Doesn't make much sense, but it is a position that the RBA need to consider. The sheer quantum of how much stimulus has been thrown at the Australian economy, it is more than 1% of GDP this year. To put that into context, the RBA are predicting growth to be around 1% in Australia this year. That means all of the growth that we see in Australia is coming from the government sector. It is from lower taxes and increasing spending that is driving up growth data, and that is a concern for the RBA when they're trying to cool the economy down. They're working in different interests, and the RBA could be forced to increase interest rates to take away this benefit. And finally, we have the employment story. This is the really confusing one. The latest employment data showed a cracker of a result. 50,000 jobs created in the month of June. It was a wowzer report card that we didn't actually need at this time. It came in just before the RBA make their decision, and it showcases resilience in the employment market because more people began looking for a job, the participation rate went up, and we added 50,000 jobs and only 10,000 people became unemployed. This total report card may be an anomaly, and it likely is an anomaly, but it came in at the wrong time, just before the RBA make a decision and when they're weighing up whether to raise rates or not. But it doesn't tell you the future story. At the beginning of this video, I said that the RBA are going to be thinking about what does the economy look like in 3 to 6 months' time, not right now. Right now, this employment data is positive, but all the lead indicators that show what employment will look like in about 6 months' time, they signal red lights. Let's check them out here. So we've got Seek, the #1 jobs website that showcases job advertisements are down 17% in 1 year. Now we need some of this. There was a lot of job ads going out about a year ago, so this is to be expected. We also have this awesome measurement of vacancies and unemployment by Westpac available here. This showcases a lead indicator. How many businesses are out there looking for workers? If fewer businesses are out there looking for workers, it means the unemployment rate's going up. So you can track what businesses are doing before it hits the unemployment rate about 3 to 6 months in advance, and that's what Westpac are doing here. And you could see a very sharp turnaround in this vacancy figure. That means businesses aren't hiring people. It matches up with the Seek data. And this means that unemployment is going to continue to rise over the period ahead. Over the last year or so, we've seen this trend up. Unemployment was around 3.4%, now it's 4.1%. But all of that slack that was in the employment market, all those people that had jobs, had second jobs, could easily go and find a job and were moving around, that's starting to go away. We've seen a little bit of this at Confidence Finance recently. We've got a job ad out at the moment. If you're interested, hit that apply button in the comments below, and we'd love to hear from you. But what we've seen is and like 5 times the number of applicants and better quality applicants coming through to us at the moment versus last year. All the businesses out there in the property space are reporting the same thing. It is much easier getting quality people through the door now, and it was much, much harder about a year or two ago when there was just too many jobs out there and not enough people. We're in the reverse situation at the moment. The number of jobs out there, the number of employers looking for workers is coming down. And the number of people looking for jobs, that's what this chart shows here, the number of job applications per job ad, it showcases that more applications per job ad is now live. You can see that here, 3% increase month on month on the Seek data, and in this chart here, the unemployment rate and job applications correlated with each other. When more applicants are applying for the same job, the unemployment rate goes up, and that is what all the lead data shows. So what will the RBA do here? Will they take a current picture of employment and look at the latest employment report card and be like, hey, hunky-dory, everything's going well, 4% unemployment rate, we're doing really, really well, good on Australia? Or will they look at these danger signs over the 6 months ahead when they make their decision? This is going to be absolutely crucial, because if you look at the current data, you probably increase interest rates. Inflation above band, unemployment near 50-year lows, and another stellar report card kind of seems like a no-brainer. You're supposed to increase interest rates in this circumstance. When you look at what it looks like in 6 months' time, low growth, the unemployment story being a little bit concerning, the cost of living crisis, households really, really lacking confidence at the moment, combine all of that, and it's a very, very different story and economy that we're transitioning through at the moment, and that's what the RBA is going to be deciding between. So what are the experts saying in terms of what the RBA are going to do? Let's check out a few different views here. Here you have Stephen Smith, Deloitte Access Economics partner. He says that any further increase in interest rates cannot be justified and will pull the rug out from under the cautious economic recovery that's going on. Should rates stay on hold, the narrative of a strengthening Australian economy through the second half of 2024 would remain intact. Further, Smith also said an interest rate rise would further crush household and business confidence and wipe out the benefits of the tax cuts and real wage gains in the second half of 2024. So that's one view. On the flip side, you have Judo Bank's Warren Hogan, Coolabah Capital's Christopher Joy, and ANU's Stephen Hamilton. All these wonderful commentators who I really enjoy reading have all argued that the RBA have undercooked the RBA cash rate, pointing to sticky inflation and persistently high unemployment. So you have different perspectives here. You have some people that say it's a no-brainer to increase interest rates because they didn't increase far enough earlier, and other people saying you'd be crazy to increase interest rates. So what do I think? I'm on the camp that it's a little bit too early to go and increase interest rates. The data may say to go and do it, but that's not the only thing that they should be looking at. They shouldn't be looking in the rear view mirror. They should be looking in the forward one. And when you look ahead, there's a lot of danger signs out there. And that danger sign means that it's more comfortable and safer to simply watch and wait and collect more data instead of increasing interest rates. Now, I say this before the latest inflation print comes out. If it comes in way too high, then I think the RBA will increase interest rates. Their hands will be tied. But I don't think they should.